On the surface, this tax haven system of activity appears as an injustice to democratic and republican government, when the sad fact is, this system is wholly embraced and supported by various governments across the world, Ireland of course being one. The elites of politics, business and finance believe this system to be crucial to the longevity and prosperity of global capitalism, while trying their best to keep it being common knowledge among the tax-paying masses. The political elites of the West being indiscreetly and quietly in support of tax havens puts them further in the spotlight and crosshairs of democratic and public scrutiny, often running on slogans and campaigns of equality and fairness as election promises. To have the rich pay their fair share, to have corporations be taxed fairly and accordingly. When in the halls and backrooms of power, government are in full support and adherence to corporations being given leeway and advantages to skip billions in taxes annually, none more so than in tax haven Ireland. Each country to offer a tax haven have what is known as sectorial specialization. Switzerland, for example, has a long and famous reputation of personal wealth management and privacy. The Netherlands specializes in corporate treasury management. In Ireland's case, there seems to be a specialization in treasury management, insurance and reinsurance companies, and services for holding companies. How this is performed is through what's known as an opt-in, opt-out model. Companies begin by declaring Ireland as their place of business, signing a number of double taxation treaties. This automatically helps them use the state's legal framework to reduce taxation close to zero, by shifting dividends, interest and royalty payments back out of the country, with no withholding tax imposed. US companies comprise the majority of those who use Ireland's tax haven status. In 1996, the IRS changed the rules of taxation of foreign profits for American corporations. From that time on, foreign profits would not be taxed by the IRS. The Irish government, through the Tax Consolidation Act of 1997, allowed US companies to take advantage of this by reforming the domestic tax code, a deliberate ploy to make Ireland more attractive for them. By creating a set of intentionally ambiguous rules in establishing a company in the state, and further access to the Section 110 special purpose vehicle to avoid taxes, companies have flocked to Ireland ever since. The Irish Corporation Tax Code gives companies multiple ways to manage tax. Among the options include, if they wish to pay taxes in Ireland, be incorporated in Ireland but not pay taxes. In the case of American companies, to inform the IRS they are registered in Ireland, while also informing the Irish authorities they are operating overseas. A third option being if they wish to incorporate in a foreign country and still pay Irish taxes by means of a tax treaty between the two countries. Tax treaties define a company's legal standing and to where taxes should be paid, what legal protections are in place, and how disputes are managed. For corporations, essentially they ensure no double taxation. The tax haven industry is so important to the Irish government, it has so far negotiated more than 70 bilateral tax treaties. The second stage, known as the profit sheltering stage. The tax office applies a series of deductions to move a company's profits from gross trading to total taxable income, thus estimating total amount declared annually and how much profit is subject to tax. Companies get to move billions in profit through the system, paying as little as €1 on every 3, reducing taxes on declared profits to between 3 and 4% per annum. This is done through two methods, known as transfer pricing and loan manipulation. Recalling how a parent company can have multiple smaller corporations within its group, transfer pricing, known as TP, works basically by manipulating internal prices, so that most profits of any number of those smaller corporations are what is called booked in a low-tax country. This is possible due to how large an area the parent company covers in global trade and market share. The parent further avoids paying tax by having its smaller corporations sell commodities to each other, essentially mirroring what an external company would pay. This fools tax authorities, as it is often done using intellectual property, such as trademarks, logos, and other visual assets. These are a continuous grey area in the world of taxation rules and regulations. How companies profit from this transfer pricing is by basically undervaluing internal commodities going to low-tax countries and overvaluing them in higher-tax counterparts, thus profiting off of the difference and being extremely lucrative. Under direction of the EU, the Irish government adopted a TP regime as late as 2010, which, while supposedly monitors and polices this activity, appears to do so poorly, as billions involving TP activity are flushed through the country annually. The tax office has its limits, as its main job is to protect resources in the domestic Irish market, but completely ineffective when dealing with global companies moving higher than normal profits into the state. The government have intentionally designed this mechanism to be essentially one way, on the surface appearing to comply with EU standards and OECD anti-avoidance regulations, while still allowing billions to be funneled annually.